We had a very significant week this week in all the financial markets, and I'm going to talk about that. And I think a lot of people in the financial media really are missing the significance of what happened, and they don't really understand it. Sure, they're reporting on some of the movements, but they don't really get what it portends. Well, first of all, the stock market in the U.S. had its worst week in 6 months. The Dow Jones was down 2.7% on the week, and it's now barely up on the year. S&P 500 dropped 3.5%. That's down 1.7 on the year. The NASDAQ was down 4% on the week, 5.6% on the year. And the Russell 2000, the weakest of the major indexes, down 4.5% on the week, 7% on the year. I think we're close to 17% off the November-December peak, almost in a full-blown bear market in the Russell 2000. Stocks got hammered on the week. Now, people are trying to say, well, what's the reason? We're getting some weak economic data. We got, some weak jobs data this week. People are starting to get worried. They're also worried about tariffs and how they might impact the economy. But that's not the most significant problem that's underlying the market that I think is going to continue. Because bonds did not rally on the week. This plunge in the stock market, which would ordinarily cause investors to buy sold treasuries. The problem is actually in the bond market. And that's what's worrying the stock market. The big news is the huge spike in yields in Germany and the rise in the euro and other currencies. The dollar had its weakest week since sometime in 2020.